Adulting in Singapore is hard, but over the past decade, my husband Darren and I found another path. We started our first business at 18, bought our first home at 23, got married at 24, and by 26, we left the corporate chase to pursue travel without any financial pressure. And after all of that, here's what I realized. You don't need to be a slave to a 9 to 5 if you start early. You don't need rich parents, even though of course it helps if you do. And you definitely don't need to work and retire at 69 just to live your dream life like the wealthy do. You just need a simple roadmap and the commitment to follow it. But somehow, no one's teaching it. So in this video, I'm going to share with you the exact strategies we use to build our freedom early and how you can do the same, even if you're just getting started. So here's what we're gonna cover. First, we are going to get brutally honest about the goals and the life that you want to build. From there, we'll come up with a very clear picture of your real net worth and whether your dreams will remain as dreams or will it become a plan that will manifest into reality. We'll then talk about where you can keep your money and the best credit card strategies to spend it so that it pushes you towards your goals faster. We'll then move on to investing. I'll show you when to start, how to know that you are ready, and why it matters more than you think. And then we'll move on to the 3 biggest traps that most people fall into. We'll touch on buying property and why it may or may not make sense for you today and what to do about it. I'll break down the complicated and, may I say, often sleazy world of insurance. And finally, car buying, which is the hidden wealth killer that wipes out most savings. And it's one thing to listen, but it's another to apply everything I'm saying to your own finances. If you want to explore any of the templates or guides that I mentioned, they are all part of my Freedom Acceleration Toolkit that gives you the tools you need to manage your finances so that you can focus on more important aspects of your life like your relationships, health, and happiness. I'll link all the details in the description for you to check it out. By the end of this video, you can consider yourself financially literate and you have the exact roadmap to live a life that you love with a secure financial base. Okay, let's get started with section 1. I want you to imagine your life like a plane. You are the pilot, your money is your fuel, and your goals are your destinations. But here's the problem. In Singapore, we grew up with a very clear structure. Study hard, get good grades, enter university, and get a good job. But after age 23 or so, that structure disappears. So most of us run on autopilot. We take off without any map and we react to turbulence while being trapped in a rat race. And because of this, most people start measuring progress by default, like how much they earn, how expensive their house is, and how much they have in CPF. And it's this that I believe is a trap that keeps us miserable because we perceive money as the destination and not just fuel that gets us there. So in other words, money gets you somewhere only if you know where you're going. That's why we goal set. Not for motivation, but to know where we're going because if not, no amount of fuel will get us where we want to go. So this first step is about taking control of the cockpit because before you save or invest, which we'll get into later, you need to chart your own flight path. So let me start with an example. The top 3 destinations that I believe many of you guys can relate with. Buying a home, traveling the world, maybe having kids. If that's not your 3 destinations, write yours down. Every single goal that you have for yourself, write it down. Even the ones that feel impossible, the ones that people tell you is unrealistic, I want you to write it all down first. Don't let anything deter you at this moment. Pause the video and write it all down. And then next to each goal, jot down a rough idea of when you want to achieve it, a time frame. Now this might seem like a small step, but it's everything because the when of your goal changes the how of how you manage your money. And this timeline matters so much because the more time that you have, the more powerful your money will become. So let's say one of your goals is buying a home. And I know many of you are around 25 to 34 years old. So you got one of the most powerful things on your side, and that is time. Now, this is backed by a century of Singapore's national data, where the savings rate is around 36 to 37% of disposable income. So if you earn $5,000 a month, you save around 3,700 of your paycheck that goes into buying your home. As of 2024, the median resale prices for HDB flats are around $590,000, and you need 20% for down payment. If you're single, it takes around 32 months of savings to earn that down payment. But if you're saving it as a couple, assuming that you are both earning around the same amount, it will take half the time. If all goes well, it just takes over a year to save for the down payment. So if your HDB goal is coming up in the next 1 or 2 years, that's definitively a short-term goal, which is anything that is happening in the next 5 years, like getting married, beefing up your emergency fund, or going on a long holiday. Here's the thing, where you put your money matters, because short-term goals need stability and liquidity, not volatile market returns. So it needs to be in a place that is very safe and accessible, and the market is not the right place if you need it soon, especially if it's important to you. Then you have medium-term goals, which is anything between 5 to 15 years away. So maybe these things could be upgrading your house, buying a car, quitting a job to start a business, or any other long-short dreams that you have. This is where your money should work a little bit harder for you, and the chances of you riding out the ups and downs of the market will improve massively. So for medium-term goals, you want to start looking at investment accounts, and we'll look into the best options for you later. And then there's long-term goals. So this is anything 15 years and beyond, like your retirement, kids' school fees, maybe taking a step back from work and giving yourself the flexibility to do new things, do things that you always wanted to do but did not have the time to. This is giving your money the time and space to grow in a serious way. Now, for goals in this long-term timeline, you have to be investing your money. If not, you're leaving a lot of money on the table. These long-term goals feel far off, they're easy to push aside, but ironically, these are the ones that you have to start taking action today. Why? Because with a longer time horizon, the more powerful your money today becomes. And because you have one of the most powerful forces on your side, and that is time, it almost guarantees you financial success. And this is backed by over 100 years of financial history, where anyone who put their money into the S&P 500 has never lost money, not once. And in every 20-year stretch, the market delivered a positive return, and even in the weakest period, the return was still over 4%. Except for one unusual case, if someone bought in 1928 and sold their investment in 1948, they would have returned 2.86% rather than the minimum 4% they would have gotten in any other 20-year period. 79% of the time, the returns were 8% or higher, and 59% of the time, they were 10% or higher. So, what does this all mean for you in real life? So let's say you invested $100,000 and left it alone for 20 years. A 4.4% return will have given you $219,000. An 8% return will have given you $460,000. And a 10% return, guess what? It will have given you $670,000. That's nearly 7 times of your saving. It's about making your money work hard for you and letting the market do what's been historically done to get you to your goals faster. And say, okay, if you don't have 20 years to invest the money and you only have about 10 years, the data still holds solid. Most 10-year periods in the market still delivered really strong positive returns, and in most cases, double digit. There were a few exceptions. If you, for instance, bought it in 1998 and sold it in 2008 after the financial crisis, you will have made a small loss of 1.4%. But those cases are outliers, they are not the norm. Now compare that to a 1-year holding period. You can see that the market is very unpredictable. You can make a lot, you can also lose a lot. You just don't know. So if you got a short-term goal, something happening in the next year or two, the market isn't a right place for your money. And that circles us right back to why setting a clear timeline matters so much. Because once you know when you want something to happen, picking the right strategy becomes clear for you. So for now, in this section, all I want for you to do is to write down your goals that you want to achieve and make sure that you identify which is a short, medium, and long-term goal. Now, here's the part that most people skip, but it is everything. Talk to your partner, talk to your family, talk to anyone that you want to do life together with. And this might take weeks, months, but it will save you years of friction, because financial literacy means nothing if you and your co-pilot are flying to different destinations. But once you're aligned, once you realize that you both are on the same team, everything will become faster, everything becomes easier. You probably have to revisit this exercise often. Your goals will change, and that's normal. But the goal is to stop flying blind, to stop letting life happen to you. Because without this map, you're letting your company or society dictate what you will do for the next 40 years. And that's how some people end up with 1 year of experience repeated 40 times. But if you fly with intention, you can create a life with 40 years of real, fulfilling experiences on your own terms. Okay, so now we're moving into one of my favorite sections. We're turning everything that we plan into reality now. And this is so incredibly important. I cannot stress it enough. And sorry for the change in background. We'll have a couple more of these changes because we're filming on the move, and right now we're here in beautiful Seville. There is a quote that I love, and it's from the book Diary of a CEO by Stephen Bartlett. When an ostrich senses danger, it buries its head in the sand. So the ostrich thinks that by burying its head in the sand, danger will eventually pass. And we humans are no different when it comes to difficult conversations, things that we are uncomfortable to talk about. We tend to also avoid them like the ostrich. Especially when it comes to our finances, most people ignore this. But before you make any real step towards your goals, you have to know where you stand today. This is about taking an honest snapshot of your money, your income, your net worth, your expenses, and most importantly, the gap in between. Here's the tracker that I use to manage my finances together with Darren. This is the couple's version. There is also a version if you're managing money by yourself. There are many different money trackers online, but if you don't have one, you can use ours. The absolute key here is to find one that keeps things super simple and don't feel like a chore, so that you can keep on track. There are 3 numbers that should always be at your fingertips: your net income per year, expenses per year, and surplus and deficit for the year. If you're starting out, maybe you don't have these numbers at hand yet, but just go in at the end of every month to check your bank statements or credit card statements and log it all down. Now, I know that it might seem tedious, but I promise you that it will be worth your time, especially if you track it on a yearly basis. You can really get an accurate picture of your finances, because it captures everything like your occasional expenses, holidays, bills, and little things that you'll miss out if you only look at it from month to month. Start with your income. It's your salary, side hustles, dividends, interest, add them all up. If you're not sure what side hustles to start, we have tons of videos on them, you can check it out. And indicate whether it's an active source of income, like your salary, or a passive source like bank interest. Then, look at your expenses. See what are the regular bills that you always have and the irregular bills that come out spontaneously. Now subtract your spending from your income, and the number that you will get is everything: surplus or deficit. Here's the truth. Your finances are either keeping you stuck or moving you forward. If you are spending more than you earn, that's income deficit. And over time, it quietly drains your savings, racks up debt, and gives you more financial pressure. But if you have money left over every month, that's income surplus. That's fuel for your savings, investments, and ultimately your freedom. The bigger your income surplus, the faster that you can buy back your time, options, and your independence. And we'll dive into how that works in the upcoming section. Now, let's break down net worth, your most important number. It's simple. Net worth is the value of all your assets minus the total of all liabilities. Put it another way, net worth is what you own minus what is owed. Assets are anything that you own that has value, like savings, property, investments, major purchases. And liabilities are anything that takes money away from you, like your mortgages, your car loans, debt that you owe, and the gap between those two is your net worth. And you want it trending up. Here's why this matters. Your income pays for your lifestyle, but your net worth, that's what buys you your freedom. So from today, the goal is clear: to grow this number. Every dollar that you earn should either build an asset or avoid a liability. That's a pattern that you'll see in every smart financial move, whether it's buying a property, investing, choosing where to spend your money. It all starts with one thing: an honest snapshot of where you stand right now. Now let's do a money personality quiz, and it's a really helpful way in determining your financial goals. There are many money personality quizzes out there, including one by OCBC that identifies 6 financial personas based on their survey of 2,000 working adults. You can do this if you want to, but what I found is the Khan Academy's Money Personality Quiz is far easier, simpler. There's only 5 questions in this, so let's do it together. Pause this screen if you want to and answer these 5 questions: A, B, C, or D. Now for the scoring. If you answered A, give yourself 1 point. And if you answered B, give yourself 4 points. C, give yourself 5 points. And if you answered D, give yourself 2 points. Tally up your total and let's break down what your score says about you. If you have between 5 to 9 points, you're the spender type. So this means you're someone who lives for the moment, you enjoy spending, you probably see money as a tool for enjoyment, but that can make savings tough, and impulse buys might be your kryptonite. So be careful, it's easy to fall into debt traps. If you're between 10 to 14 points, you are the balancer. You got a decent hand on how you handle money, you can make responsible choices, but sometimes overthink them. This can lead to missed opportunities or unnecessary stress, and a little more confidence can take you further. If you score between 15 to 19 points, you are the saver. You are laser focused on your goals, your budget, your plan, your discipline. But sometimes that can come at a cost, like skipping out on small joys or struggling to be generous. Remember, money is also meant to be enjoyed. And lastly, if you have 20 to 25 points, you are the investor. You are the strategist. You think long term, take risks that are calculated, and aim to grow your wealth. But it's not just about your money. You want your finances to fuel your freedom and impact, but you also have to watch out. You might be focusing too much on your future but overlook your present needs. So when you have done the quiz, drop them in the comments to see how many of us are in which categories. For me, when I first started and I did this quiz, I was a spender. Now that isn't a bad thing, but I knew that I had a bad idea of money and how I wanted to spend it. Sometimes I spend it on things that I really wanted, but might not be a good financial choice in the long term. But once I realized my goals and I actively worked towards them, I adopted more of like the saver mindset because I wanted to save as much as I could to get to my goals faster. So this is also not a good thing, because if you're so hyper focused on achieving that goal, once you achieve that, then you might have certain feelings of like, oh, now what? Do I set another goal, a higher one, and achieve that? So that might keep you in an endless cycle of chasing after monetary goals but not enjoying the present. So when it comes to money personalities, there are different types, there are different personalities, but it's important that you know yourself and to keep watch of blind spots. Okay, so now we're moving on to the most practical section where we are turning everything that we have planned into reality. And this part will help you make sense of exactly how and when you achieve your goals in a straightforward way. We'll start off with a 5-year forecast based on what we know about your finances today. And this can actually be one of the most freeing things that you can do for yourself. And the best way to explain this or convince you of this is to go back to the airplane analogy. So the goals that you have outlined for yourself is your destinations. And we have already done this in the previous exercise. You should have absolute clarity of what they are now. We have also done an analysis of your income, expenditure, and your net worth, which is taking stock of your fuel and how much is left in the tank. Now what we're going to do is to lay out your flight path, which is a 5-year forecast looking forward. And essentially, this is a path that you are flying that will get you to your goals or not. This really forces you to look beyond next week, next month, and look ahead at a 5-year mark to make sure that you are holding yourself accountable so that you don't miss your destinations and correct your flight path if need be. When you can start to see not just your next year ahead, but the next 5 years ahead, you start to notice patterns and opportunities that you will otherwise miss. You spot turbulence before you hit them, like your wedding coming up. So without knowing your destinations, your gear control, your flight path, you'll be flying blind. And notice this, regardless of how much fuel you have in the tank, you'll just be flying aimlessly without knowing where to land. This is why a lot of people seem miserable or disillusioned in life, because we don't have a goal and destination, or we don't know what exactly we want in life, even though most of us live a seemingly comfortable life. So the issue isn't about money, it's how we allocate them to make sure that they are pushing us towards our goals. And this is what we'll do right now. So how do we start? The first is creating your base case. Essentially, this is your what if I keep going on like this plan. You take what you know about your income and spending and project it to the next 5 years. We'll do this for both your cash and your CPF ordinary account, which can be used towards goals like housing. That's why it's important to have a good understanding of where it's headed to, especially if your goals revolve around that. Okay, so of course the assumption for the base case is that you will remain employed at the same job or at least have the same amount of salary. And also, we don't take into account the upside opportunities like getting a promotion or getting a raise. Therefore, it's probably the baseline of your finances, assuming that you continue to be a good worker and will continue to be gainfully employed if you so desire, which I believe most of us will be in the same position, especially if you're watching this video. So in this step, you will get clarity on your cash surpluses across the next 5 years, which is essentially taking this year's and the past year's surpluses and adding that up. And this is the same for your CPF OA projections as well. With that, we have a clear understanding of your current and future cash and your CPF OA balances for the next 5 years, which is the time frame for your short-term goals. Now, all you have to do is to go back to the goal setting sheet, take those short-term goals, and with the estimated costs, plug that into the sheet. This is where the magic happens. By matching your goals with your cash and CPF balances, you now have a crystal clear understanding of whether or not your goals will match your current financial reality. So in my given example, if an individual has a $5,000 salary with some side hustles and some passive income, she will be able to achieve the 3 goals that she set for herself of buying a resale HDB, starting a business, and traveling in Asia, and she will know for sure she can do this within the next 5 years. But this picture may not look so rosy for every single goal. So what happens then if you're forecasted to miss a goal? This is where monthly check-ins happen, which gives you the opportunity to ask strategic questions like, can I shift more money into savings? Can I cut back on spending big-ticket items that I know are coming up? Can I reduce the cost of fixed expenses that I know I need to pay? I want to focus on the last point of reducing expenses, which I believe that most of us are not taking enough advantage of, like utilities, Wi-Fi, phone bills, all these things that everyone has to pay for. I used to pay maybe around $50 for the plan a month, but since more telco companies have been coming up, there are many other good deals that you can get. So for essentially the same thing, you can get it at maybe $8 instead of $50. Another thing, like groceries, instead of shopping at specialty supermarkets, there are always cheaper alternatives. And no, I'm not saying go on for a full saver mode. It's just these little things that you can reconsider and take the time to figure out to reduce your expenses in exchange for achieving your goal. And then we'll move on to the next part, which is how much you need to invest. And you can come back here to this page and continue to tweak until you are happy with balancing your short-term goals with your medium and long-term goals. Okay, so now look at the screen. This is a really popular budgeting framework, the 50-30-20 rule. which allocates 50% into our needs, 30% into wants, and 20% into savings and investments. You should be measuring this on a monthly basis because it helps you make slight improvements to your spending along the way. Especially if you're not projected to hit your short-term goals, you need to be taking this seriously. 50% of your take-home pay should be allocated into your needs. So things like your utilities, your mortgage. 30% should go into your wants like travel and holidays, and the last 20% to your savings and investments. There are many different definitions of what constitutes a need versus a want, and that's why they call it personal finances, because it is in fact very personal. This rule is not hard and fast. It's also up to you to tweak the percentages so that it makes sense for you. So in this case, the data that we see on the sheet looks really healthy according to the benchmark, where the spending of needs is well below 50%. And this can be the case if you're not spending on really high-ticket things like rent and living with family. In this case, savings and investments can go over 50%. As for the wants, it's right on target at 26% instead of the benchmark at 30%. When it comes to your monthly check-ins, what I recommend is to ask these 3 questions. What am I willing to sacrifice that will not significantly impact my quality of life today? Think of things like your daily bubble tea, unused gym membership, or multiple streaming subscriptions. Number 2, can I get the same thing for less? Maybe it's switching to a different phone plan, cooking at home instead of eating out. And the last thing is, am I allocating enough for my future self instead of just my current self? If you're consistently undersaving, it's a sign that your lifestyle needs recalibration. When you combine your 5-year forecast with your monthly check-ins, you build a practical roadmap that will keep you aligned towards your goals, helping you both balance short-term goals and your long-term ambitions without sacrificing either one. By the way, if you're someone who wants to take control of your money but you don't know where to start, or you don't have the time and energy to build all these spreadsheets from scratch, we've put together the Freedom Acceleration Toolkit for you. It's designed to give you everything you need to get total clarity on your finances without the stress or guesswork. Inside, you'll find ready-to-use spreadsheets, calculators, planning templates, plus a roadmap that takes you through the exact same process that we use ourselves, from setting goals to creating your savings, investments, and spending plan. And if you want to go deeper, there is an option to book a one-on-one consult with us. In this session, we'll walk you through your full money picture together, and we'll help you map out a full action plan so you know where to focus next. And if you're doing all this with a partner, you can do a couple session with the Prepare and Rich framework. It's a structured conversation around values, money, and future plans. Think of it like relationship counseling, but super practical. It's honestly one of the best ways to build alignment with your partner and avoid a lot of common fights and disagreements that come up later. So I hope you love it, and if you want to check it out, there's a link in the description. Now let's discuss the best places to save and invest your money. If you jump to this section, I want you to go back to the goal setting again, because before you ask, where should I put my money? It's pointless without knowing the life that you want to build. So don't skip out on that. Let's start with high interest savings account. Why do people like them? They are predictable and stable. They are insured by SDIC up to 100k per bank per person, and you have instant access to your money anytime. Just note that the interest rates are usually capped at 150k, so anything above that wouldn't actually make sense for you. It also requires you to meet certain requirements every month, like crediting your salary, minimum spend, or gyro transaction. Rates may also change anytime without any notice. For UOB1, you can earn up to 5% per annum with the credit of your salary, minimum spend, or gyro transactions. This has been our favorite fast-free option for generating good interest on our bank balance by just meeting 2 requirements. There is a 500 eligible spend card monthly, a minimum of 1,600 salary credit, or at least 3 gyro transactions. And the usual combo is usually meeting your monthly spend with crediting your salary, because that's the most straightforward method that most people can meet. The maximum effective interest rate is 3.3% for 150k, so anything above that, it wouldn't make sense for you to leave your money in it because you won't be earning any additional interest from it. Say you have a bank balance of $10,000. You will earn about $430 a year, which makes up about $35 a month. If you have a balance of $150K, you will earn an annual interest of $4.95K with a monthly interest rate of $412. And you can use the calculator on UOB's website to see a gauge of how much interest you will have based on your bank balance. Oh, and by the way, inside our Freedom Acceleration Toolkit, we'll show you how we still meet the salary credit even though we are not formally employed. So if you are self-employed, freelance, or in between jobs, this will still help you qualify for your interest. We'll show you how to do it step by step, completely transparent, or what to do if you accidentally miss your credit for the previous month because your salary came in late or didn't get processed in time. It's all in there. Now, if you don't mind a few more hoops and maximizing your interest through a few more criteria, OCBC might be worth the look. For OCBC 360, it's a little more complex than the UOB One system. It has a tiered interest system that rewards you more based on the criteria that you meet. There are 6 in total that you can use to unlock your bonus interest. You don't have to meet all of them, but the more that you hit, the more interest you earn. Let's take the same base case that we use for UOB One. You credit your salary and you spend at least $500 on your card every month. With the same balance of $10,000, you get $18 a month. And with the balance of $150K, you're looking at $218 a month. Now, compare that to the UOB One system. It doesn't really make sense unless you are also increasing your average daily balance by at least $500 a month, purchasing eligible insurance and investment products from OCBC. And if you hit those criteria, your interest rate might eventually outperform UOB One. But honestly, for most of us, especially if you're under 35, UOB One probably gives you a better deal with fewer steps and less complexity. So unless you are going all in on OCBC's full ecosystem, UOB One would be a better choice. Another great option if you are just starting out and want daily interest is the GXS Savings Pocket Scheme. There are different types of accounts or pockets that you can put your money into, and there isn't any requirement like hitting your minimum spend or crediting your salary. But what I found is most of us probably shouldn't go with this option unless hitting your minimum spend or crediting your salary will be an issue for you. Now for a 10K balance, you will get $17 a month, and for a 150K balance, you will get $260 a month. Here's a summary table for all 3 accounts. Honestly, for 90% of us here, UOB One would probably be the best option as long as you can hit 2 of the 3 requirements. Short-term T-bills. If you're someone who values safety and predictable returns, and you don't want your money sitting idle, this option would be for you. Why do people like T-bills? They are Singapore government-backed, and that is as low risk as it gets. They also give you solid returns depending on the time period. However, the recent 6-month T-bill closing yield was about 2.04%, which is not exactly great in the context of the savings account that we just spoke of. Sometimes it can be higher, so you just need to monitor them. Another thing, it is very short term, 6 to 12 months, so it's perfect if you know when you need your money. So let's say you have $10,000 set aside for a wedding 12 months from now. If you buy a 6-month T-bill today and reinvest in it after it matures, you could make $200 in interest with virtually no risk. But just a quick heads up, your money will be locked during that term, so you can't withdraw that. You also need to participate in an auction process via competitive or non-competitive bids. But don't worry, if you're not sure what rate to enter, just go with non-competitive. You'll get the market yield automatically, no guesswork. Okay, so here's the summary. If you're just starting out and want to keep things super simple, just go with a high-interest savings account first. Sure, there might be some options that give you higher interest, but if you've just started on your journey, the best way to be consistent with it is to start simple first. Once you've grown a little more confident and competent, you can then start to explore other options that maximize your returns. Once your short-term goals are handled, it's time to think bigger. Not too far off, but not right round the corner either. Picture this, your child is starting school in the next 6 years. or you want to start taking your sabbatical that you've been dreaming about for a really long time. These aren't pipe dreams, they are medium-term goals, and the right strategy can make them real. Here, you want moderate growth with manageable risk, a balance between stability and compounding. Let's start off with Singapore savings bonds. Why do people like SSBs? They are very low risk, also government-backed, flexible. You can redeem them anytime after 1 month, and you always get your capital back with no penalties. So this is great if you want flexibility with no capital loss risk. Interest rate steps up over time, so the longer you hold, the more you earn. An example would be a June 2025 SSB offers a 2.06% in year 1 and up to 2.49% in year 10. The current rate is pretty low and falls short of the peak in December 2022, where the 10-year average interest rate soared to 3.47%. Just note there is a minimum amount of investment of $500 and in multiples of 500. The total amount of savings bonds you can hold at any time cannot exceed 200K per person across all your SSB holdings. Interest is also paid every 6 months, not monthly, and returns may not be that attractive, similar to T-bills where there will be good times and times where it isn't doing too well. There may be time periods where it makes sense and times that it won't. You just have to monitor, and of course we'll also keep you updated if you're part of our mailing list. If you're not quite ready to DIY your investments or just want a low-effort way to get started, robo-advisors can be a great balance between saving and full investments. They provide automated investment services and a hands-off approach to investing. They are generally cheaper and require lower account minimums than traditional financial advisors. So why people like robo-advisors is because they are easy to onboard in minutes, it provides potentially higher returns for your medium to long-term goals, and there's typically no lock-in so you can withdraw your money anytime. Just note that it is not capital guaranteed, so you may experience certain periods of negative returns. Some platforms may take 1 to 2 days to process your withdrawal, and unlike banks, it is not covered under SDIC as it is a full-on investment and not a bank deposit. Now, there are hundreds of different types of investment products out there, but the general principle that you have to remember is when it comes to investing, the higher your expected return, the higher the risk. Let's try something. If you had to lock in $20,000 today for something 5 years away, would you choose returns, flexibility, or guaranteed safety? There's no correct answer, it's just what fits your life today. I picked these 3 as an example just because they are quite popular and are suitable for you based on what you've answered. So now let's talk about flagship portfolios from Endowers. Think of this like your main engine for your long-term investments. They are globally diversified, professionally managed, and come with complete free transparency. Each portfolio combines equities from top fund managers like Vanguard, Amundi, Dimensional. You also get discretionary portfolio management. That means Endowers monitors, rebalances, and adapts your portfolio according to the market. But it still comes with a catch. That is, market risk still applies. Your capital is not guaranteed, and if things go south, you could lose your money, especially over the short term. It is also not the highest yielding option in bull markets. Flagship is balanced, which means it can include equities and bonds. And in a strong bull market, a 100% equity ETF portfolio might outperform it. So if you're chasing maximum performance with high risk tolerance, this might feel a little safe. And lastly, fees are low but not zero. While their fee is quite competitive, it is still higher than DIY investing through brokers like IBKR, which we'll cover in the next section. That said, you're paying for advice, convenience, and active monitoring. If you're more risk averse and want your capital guaranteed, you can also consider SIVE Cash Plus Guarantee. This is a fixed deposit style account offering capital and return guarantees for locked-in periods of 1, 3, 6, or 12 months. Your guaranteed returns also depends if you choose to deposit in USD or SGD. Just make sure that you are okay for your funds being locked up for the tenure that you chose, as no early withdrawals are allowed. This is a great option if you want predictable, secure returns and are okay with locking funds. Now thirdly, Mary Invest Income. The name is quite clear what it is for. It is for those seeking higher yields and monthly payouts and are okay with a little volatility and a short withdrawal wait. The returns are about 4 to 4.5% per annum based on the 2024 yield data, and it delivers consistent monthly income. Similar to Endowus Cashback, your capital is not guaranteed in this case. Here's a summary table for all three accounts. Choose Endowus if you want to build a diversified portfolio. Choose Safe Cash Plus Guaranteed if you want certainty and are okay with locking your funds in. Choose Mary Invest Income if you're targeting monthly payouts and are okay with minor risk with a chance for higher yield. Now let's zoom way out, 15 years or more. Imagine it's 2045 and you're sitting in Bali, retired early and sipping your coffee. You're not lucky, you're prepared. Because 20 years ago, you decided that you will invest with your future in mind. So while short-term and medium-term planning focus on safety and accessibility, long-term planning is all about growth. Depending on your risk tolerance and how involved you want to be, here are 3 popular ways that people in Singapore grow their wealth. CPF, Singapore's built-in retirement engine. It's surprisingly powerful if you know how to use it. Why does CPF work well for long-term goals? It is forced savings. Like it or not, it will build up. There is a high risk-free interest, 2.5% for OA, 4% for SA, and even more for the first 60K combined. There is tax relief, so topping up your SA or your loved one's accounts can reduce taxable income. It is also safe and predictable, backed by the government. Just note, it's not liquid. You can't access your money freely before 55, and even after, it's not just free for all. Returns are fixed, so if you want more aggressive growth, CPF alone may not be enough. Bottom line, CPF is a solid foundation, but you probably want to supplement it with other investments if your goals go beyond the basic retirement. Number 2, global equity ETFs for growth and freedom. If you want your money to work as hard as you do, global equity ETFs are where long-term compounding really shines. Why do people invest in ETFs? There are low fees and you have full control if you're a DIY investor. You have access to broad markets like the S&P 500, Nasdaq, or MCSI World. Historically, equities deliver 6 to 8% returns over the long run. But remember, you need to be comfortable with volatility. Your portfolio can drop 20 to 30% in a year and you have to still stay invested. And it's not for emotional investors, those who might panic sell. If you're open to learning and prefer the DIY route, platforms like IBKR can help you build your global portfolio, and you can even automate your investments from your bank account to your IBKR account and automatically invest in your index of choice. This is how many people build their freedom portfolio, one that works quietly in the background, compounding month by month, year after year. Just avoid the common mistakes of trying to time the market or chasing trending stocks. The real gains come from staying consistent and not guessing what's going to moon next. So what's your version of that beach moment? Is it retiring early, supporting your family, leaving something behind? Your goals define your plans. So what are you building toward? Number 3, real estate for income and inflation hedge. In Singapore, property is more than a shelter. It's often viewed as a wealth vehicle. Why do some people choose real estate? Rental income provides passive cash flow. You have appreciation over decades, especially in well-located and limited supply markets. It also serves as a hedge against inflation. But here's the other side. There is a high capital requirement and long-term commitment. Property cycles can also stall or decline, and it's not just up. There's also maintenance, taxes, and tenant risk, and these are real headaches to deal with. Real estate can be a powerful tool for long-term investment, but it's also illiquid and it's not for everyone. Think carefully before jumping in. And if you want exposure to property without a 6-figure deposit, REITs or real estate investment trusts are a more accessible way to invest in the property market. What's the right mix? Here's the truth. There is no perfect formula. Your long-term plan depends on your risk tolerance, how hands-on you want to be, your income and savings rate, and most importantly, your vision of life 20 years from now. But if you walk away with one idea today, let it be this. The earlier you start, the more forgiving your mistakes become. Even small amounts invested consistently over decades can transform your future. The key is to not get it perfect. The key is to start. Whatever system that works well for you, do it today. Let your system grow with you. So to recap, start where you are, use what you have, and most importantly, stay consistent. Because building wealth isn't about being perfect, it's about being patient. Credit card strategies that actually make you money. Let me tell you a story. A friend of mine used to hate credit cards. He got into a $10,000 credit card debt and he swore that he would never touch them again. But a few years ago, he made a realization. If I'm gonna be spending money anyway, how do I make the most of it? And that's the real credit card game. Not about borrowing, but it's about turning your everyday spending into cashback, rewards, and free flights. Only if you know what you're doing, like paying off your credit card bills in full every month. If not, you'll be in serious financial trouble. Now, let's simplify it. There are only two main parts, cashback and miles. And you can choose them based on how much you spend every month. If you spend less than $3,000 every month, go cashback. If you're watching this and thinking, I don't have a company budget or a travel lifestyle, cashback is your friend, especially if you spend less than $3,000 a month. It's simple, predictable, and useful. We use the UOB One card, and this is our go-to because you can spend $500, $1,000, $2,000 for 3 consecutive months and you get a lump sum cashback every quarter. So if you do achieve the 3-month consecutive $2,000 spending, just note that the max cashback is $200 every month. But if you miss the threshold once, you do get penalized for it and you'll fall to a lower tier. Now, if you're on the OCBC 360 savings account, then the OCBC 365 card will be for you. It gives you up to $160 of cashback a month, and that makes up to nearly $1,920 a year. And this happens as long as you spend at least 1.6K every month. Now, if you spend more than $3,000, go for miles. This is where it gets juicy. Maybe you're a high spender, or you're spending for your family, or if you're spending under a business. Miles gives you the best bang for your buck. Here's the math. So around 4 miles per dollar is the gold standard. At 1.5 cents per mile, that's like getting 6% back, but for travel. The best redemption I've ever made is around 49K miles from Singapore to Istanbul on business class, and that value gives over $4,000 in cash. If you're flexible with travel dates and are okay with booking 9 to 12 months in advance, then the miles scheme is for you. Here's our lean and efficient setup. The UOB Ladies Solitaire card gives you 4 miles per dollar for 2 categories. City Rewards is for online shopping, 4 miles per dollar for the first $1,000 a month. And DBS Women's World card gives you 4 miles per dollar for online shopping. And just a heads up, mile redemptions come with admin fees and sometimes miles do expire. So we use a miles tracker sheet to keep everything tidy. You only need to update it once every quarter. So TLDR, which card strategy should you use? Cashback if you want simplicity, spend below $3,000 or don't care to travel. And miles if you spend more than $3,000, want free flights and can plan ahead. Remember, don't just spend more to earn rewards. The trick is to earn rewards based on what you're already spending. So by now, we got a plan, we got a timeline, we got our money working for us. But here's the part that most people miss, avoiding the trap. Because if you fall into these, it's like trying to fill a bucket with a hole in the bottom. So let's talk about the 3 biggest traps Singaporeans fall into. Trap 1. The property stacking illusion. Everyone knows someone who got rich from buying property. Your parents, your uncle, your colleague that waited and bought at the right time. If you're trying to copy their playbook today, you're stepping into an entirely different game. The property market your parents thrived in, gone. And it's not coming back. Here's why. Cooling measures has crushed the leverage game that you could have played. Back then, the system made it easy. You could have taken 95% LTV loans, no ABSD, no SSD, no income ceiling. If you earn about $10,000 a month, you could have bought multiple properties and stacked each property, each one almost paying for itself. But today, there are tons of cooling measures like the LTV, ABSD, TDSR, and SSD. In other words, less borrowing, more friction, more taxes. Rental yields may not make sense anymore. Back then, rental yields were high, mortgages were low, and the properties practically paid themselves off. But today, the math is broken, especially if you're looking for a positive cash flow investment. Take a look at this, the Ori, 516 square foot, 1 bedder, 1 study. The launch price was almost $1.5 million at almost $3,000 per square foot. Parktown Residence, 1 bedder, 500 square foot, launch price at $1.2 million. Let's break it down if I were to buy the Ori at 27 years old today, which also means I have the longest runway for a mortgage. My numbers will be buying the home for $1.28 million. I have a 30-year loan tenure, and I locked in an interest rate of 3.5%, but I think now it's a little lower at 2+. And this is a split of the cash and CPF OA on the scheme. If my loan is about $1 million at 3.5% interest rate for 30 years, this is what my monthly repayment will be like. Besides the mortgage, I also have to take note that I have to pay maintenance fees, property tax, and insurance or other repairs for buffer, which makes up of a total cost of $62,000 plus per year. Unless I'm absolutely confident that I can rent it out at 5.2K a month with full occupancy, it's a negative cash flow property. So let's call it what it is, a capital gains bet. Because when you invest in property, you either go for rental yields or capital gain, and ideally both if the market conditions are right. Pursuing only capital gains only work if the prices of the property goes up. You can hold beyond the SSD period and you can tank at least 5 to 10 years of negative cash flow, which actually a lot of Singaporeans are still optimistic about the current market condition. But this brings me to my third point, especially for those of you who want to stack properties on one income. In the past, before cooling measures, someone with an income of $10,000 could easily stack multiple properties, sometimes even a lower income if you have a gut. And this is thanks to low quantums, high leverage, and decent yields. Now, let's compare. John, who bought his 2 properties pre-cooling on $10,000 a month income, he has no ABSD and has 95% LTV. He enjoys a positive cash flow. Whereas for Stanley, who bought post-cooling measures at the same income, he has to pay 15% on ABSD for his second property. He has a reduced loan and barely breaks even at all. So in today's market condition, someone earning twice the income at 20K would still struggle with the same strategy without taking big market risks or draining their cash. So where does this leave you? The old strategy of climbing the corporate ladder, buying your properties, retiring rich isn't broken, but it's just not as fast anymore. And in my opinion, it's no longer wise. Singapore used to be a high-growth startup nation, but now we're a blue-chip stock. Stable, respected, but not going to 10x overnight. Those who bet early on Singapore's success would have been rewarded, and deservedly so. But if you want to build wealth in this era, you need a different strategy. In upcoming videos, we'll dive into what these exact strategies are, so let me know if you're interested in them. But for now, let's talk about trap 2, insurance. The one where even smart people get scammed. Let me ask you something. When was the last time you actually looked at your insurance and knew exactly what you were paying for? Because for most people in Singapore, the answer is almost never. We either buy it from someone we trust because they say that it's important, or avoid it altogether because it feels like a scammy black hole. Both mindsets are dangerous. Here's the problem. In Singapore, insurance has a branding problem. For some, it feels like a scam, and for others, it's a source of deep regret. So let's talk about the 2 common mistakes I see people make. You meet an insurance agent for courtesy who is your friend, your relative, your army buddy, and they try and sell you everything. Whole life, critical illness, hospital plans, ILPs. They throw in things like guaranteed returns, forced savings, retire with passive income. Next thing you know, you're 25 years old with 3,800 a month, and 800 of that is disappearing into policies that you barely understand. You're essentially paying rent to your insurer with no understanding of what you just bought. On the flip side, some of you avoid insurance completely because maybe you heard of these cases, or you think, I'm healthy now, I don't need that, I'm completely covered by my company. It's too complicated, I'll deal with it later. But when life happens, like a medical crisis, disability, or an unexpected death, the costs explode and your savings disappear overnight. So here's what I've come to realize. Insurance isn't bought with wealth, it is bought with your health. It's not something that you buy when you're rich, but rather something that you buy when you're well and healthy. Because once your health changes, you don't get to choose anymore, your insurer does. My philosophy, live a life that you don't regret. And that might mean different things for many people. But for me, it's covering my needs first in a responsible way. So if you own a home, maybe get a term insurance that clears the mortgage if anything happens to you or your partner. Want access to private hospitals like Mount E Novena? Get the right shield plan while you're still young and premiums are low. Can't afford the bougie options? Lock in what you can afford now and you can always downgrade later. But upgrading later, the door might be closed if your health ever changes. So I'm not saying that you have to go all in, to each his own. I've just seen too many people cheap out early thinking that they were smart only to regret it later when they needed coverage and couldn't get it. Anyway, I'm not a financial advisor, you can leave it to yours, so I'm not telling you what to do, I'm just suggesting. So take what's useful, leave the rest, just don't stick on it completely. Because insurance isn't about being paranoid, it's about being prepared. And it's not about the worst case scenario, it's about the realistic one. Trap 3, the car, a silent financial drag. I have to spend time talking about why owning a car in Singapore is the hidden wealth killer, the depreciation, monthly burn, DOE, but I don't want to go there. Because here's the truth, owning a car is a personal choice. It depends on your needs, your goals, your lifestyle. Maybe a car makes perfect sense for you, maybe it doesn't. I'm not here to judge. But I will say one thing, if you're going to buy a car, if possible, try and buy it in full cash. Why? Because once you take a car loan, you're stepping into one of the most misleading financial traps most people don't realize they're in. Let's talk about interest rates. Most people look at car loan interest rates like 2 to 3% and think, oh, that's similar to a mortgage rate. So it's pretty low, right? But car loans don't work like mortgage loans. Here's the difference. For mortgage loans, it's calculated on a reducing balance. This means you only pay interest for the balance that you have left. Over time, your interest payment shrinks as you pay down the loan. So that's perfectly reasonable to me. But for car loans, it's calculated on a flat rate. You pay interest on the original loan amount even as you repay. Even if you paid half your car loan, your interest doesn't drop. Let's say you borrow $80,000 at a 2.98% flat rate, and the loan tenure is 7 years. The real effective interest rate isn't at 2.98%. It's about 5 to 6% per annum once you account for all the charges. So again, if you must take a loan, at least understand what you're signing up for. But if you're buying a car with full cash, then that is the clearest way without causing any financial drag for you. That's all I want to say about cars, especially from a financial literacy perspective. Alright, if you're still watching this, first of all, wow, thank you for sticking around on one of the most practical financial breakdowns I've ever made. Before this, we made this video after we quit our jobs 8 months ago to travel. It's not about money, it's not a how-to guide, it's about something deeper, the turning point. What made us rethink everything, walking away from the corporate path and start building a life that actually feels aligned. So if you're someone who doesn't just want a plan, a sense of why any of this should even matter to begin with, you might want to check this out.